One of the most debated financial questions is also one of the most misunderstood. Should I pay off my mortgage early, or should I invest the extra money instead? Most people treat that as if it is only a math problem. It is not only a math problem. It is also a risk problem. It is a timing problem. It is a liquidity problem. It is a behavioral problem. And for many people, it is a control problem. That is why two intelligent people can look at the same mortgage and come to two different conclusions. One person says, why would I ever rush to pay off a 3% loan when the markets have historically done much better? Another person says, I do not care what the market might do. I want the debt gone. I want the house paid for. I want peace. Both people may be right, but only if they understand what they are optimizing for. That is how I think about almost every important financial decision. The first step is not to ask, what answer sounds smartest? The first step is to ask, what is the machine, what are the variables, and what result am I trying to produce? When you pay down a mortgage, you are earning a guaranteed return equal to the mortgage rate. If your mortgage rate is 6%, every extra dollar you use to reduce that loan is, in effect, giving you a 6% guaranteed return. There is no volatility. There is no earnings season. There is no election year. There is no central bank surprise. There is no market crash. You reduce the liability, and the benefit is certain when you invest that same dollar instead. The return is not certain. Historically, a diversified stock portfolio has done very well over long periods, but the path is uneven. It comes with drawdowns, recessions, inflation cycles, bubbles, panic, and long periods when the right decision feels wrong. That is the trade-off. Paying down the mortgage gives certainty, investing gives potential upside. The real question is not which one is universally better. The real question is whether your mortgage rate is high or low compared with what you can reasonably expect to earn after taxes, after inflation, after volatility, and over your actual time horizon. Once you look at it that way, the answer becomes much clearer. There are really three zones. The first zone is the low-rate zone. If your mortgage rate is somewhere around 0 to 4%, the math usually favors keeping the mortgage and investing the extra money. That does not mean there is no risk. There is always risk, but a fixed 2%, 3%, or 4% mortgage can be a very powerful thing to hold in an inflationary world. Why? Because inflation works quietly in your favor when you owe fixed-rate debt. If you borrowed money at 3% and inflation averages 2% or 3% over time, the real cost of that debt is very low. In some years, it may feel close to zero in real terms. The payment does not rise. The loan terms do not change, but wages, rents, asset prices, and nominal incomes tend to move upward over long periods. That means your mortgage payment can become a smaller and smaller part of your financial life. A $2,000 payment that feels large today may not feel as large 10 or 15 years from now if your income has grown and prices in the economy have risen. That is one of the strange things about fixed-rate debt. When it is cheap, it can become cheaper over time. In that situation, paying it off too aggressively can create an opportunity cost. You may feel safer, but you may also be taking money away from investments that could compound for decades. That is the low-rate zone. The second zone is the gray zone, that is roughly 4 to 6%. This is where the answer becomes less obvious. At 4.5%, 5%, or 5.5%, the mortgage is no longer obviously cheap, but it is also not clearly toxic. Now, the spread between paying down the loan and investing is narrow. If you expect a 7% return in the market, but after taxes and volatility, your real after-tax return is closer to 5% or 6%, and your mortgage is 5.5%, then the decision is no longer clean. You are no longer comparing 3% debt with 10% market returns. You are comparing a guaranteed 5.5% return with a possible 5 to 7% return that is very different. And when the math gets close, behavior starts to matter more. Risk tolerance matters more. Liquidity matters more. Age matters more. Retirement timing matters more. The stability of your income matters more. This is why the gray zone is so dangerous for people who want simple rules. Simple rules are useful, but the real world is not always simple. When the numbers are close, the best decision is often not all one way or all the other. It may be a hybrid. You invest some, you pay down some, you keep flexibility, you reduce regret, you build growth while also lowering the liability. That is often a better design than trying to prove one side is perfectly right. The third zone is the high-rate zone. Once your mortgage gets into the 6% range and above, the logic starts to flip. Now paying down the mortgage becomes much more attractive. A 6.5% guaranteed return is not easy to replicate after taxes and risk. A 7% market return is not the same as a 7% guaranteed return. A market return can be negative for a year. It can be negative for several years. It can arrive after you needed the money. It can show up on average while still creating bad outcomes for someone with bad timing. A mortgage payoff is different. The liability is reduced immediately. The future interest is avoided. The fixed expense eventually disappears. That can make your whole financial system more resilient. I like to think in terms of systems, not isolated numbers. A fragile system breaks when the environment changes. A resilient system bends, adapts, and survives. A high mortgage payment can make a household fragile if markets fall and you lose income. The mortgage still comes due. If you retire and your portfolio declines, the mortgage still comes due. If inflation raises your other living costs, the mortgage still comes due. So at higher rates, especially when you are closer to retirement, paying off the mortgage is not only about return, it is about reducing fragility. That is a very important distinction. A person in their 30s can often tolerate more uncertainty because time is on their side. A person in their 60s may not have the same recovery window that changes the answer. Before making the decision, you have to adjust for three things. First, you have to adjust for taxes. People like to say the stock market returns 7%, 8%, 9%, or 10% over time. But you do not always keep the full return. If you are investing in a taxable account, dividends may be taxed, capital gains may be taxed. Portfolio turnover may create taxes, state taxes may apply, your after-tax return may be lower than the headline number. A 7% return may become 5.5% or 6% depending on your tax bracket, and how efficiently you invest that matters. If your mortgage is 3%, the spread is still attractive. If your mortgage is 5.5%, the spread may be very narrow, and when the spread is narrow, you are taking risk for a smaller premium. But account type matters too. If the money is going into a Roth IRA, Roth 401k, traditional IRA, or tax-deferred retirement plan, the tax drag may be much lower or delayed. In that case, the comparison changes again. That is why it is not enough to say investing returns more. You have to ask where the money is being invested. Taxable account, retirement account, Roth account, index funds with low turnover, high dividend investments, frequent trading. Each structure creates a different after-tax result. Second, you have to adjust for risk. A guaranteed return and an expected return are not the same thing. That is one of the biggest mistakes investors make. They compare the average market return to the mortgage rate and assume the higher number wins. But the market does not deliver its return in a straight line. It delivers it through cycles, booms, busts, drawdowns, recoveries, fear, greed, liquidity, central bank policy, human behavior. That path matters. If you are 30 years from needing the money, volatility is uncomfortable but survivable. If you are 2 years from retirement or already retired, volatility can be dangerous. That is called sequence of returns risk. If a major market decline happens early in retirement while you are withdrawing money, the damage can be much worse than if the same decline happens later. The average return may be fine, but your personal outcome may not be fine. That is why debt reduction becomes more valuable as you approach retirement. It reduces the amount your portfolio must support. It lowers the withdrawal pressure. It gives you more room to wait out bad markets. That has value even if a spreadsheet says investing might produce a higher average ending balance. Third, you have to adjust for time horizon. Time changes almost everything. A dollar invested at age 35 is not the same as a dollar invested at age 55. The first dollar may have 30 years to compound. The second may have only 10. When time is long, compounding is powerful enough to overcome many mistakes, many recessions, and many periods of volatility. When time is short, protecting what you have built becomes more important. That is the life cycle effect at 35. The goal is often growth and accumulation. At 45, the goal may become balance. At 60, the goal may become resilience, income stability, and reducing required withdrawals. The same mortgage rate can mean different things at different ages. A 6.5% mortgage for a 35-year old is not the same problem as a 6.5% mortgage for a 60-year old. The math might look similar. The system is not similar. The 35-year-old has time. The 60-year-old needs durability. That is how I would frame the decision. Now let us look at the two broad paths. The first path is keeping the mortgage and investing. This path is optimized for growth and optionality. It tends to make the most sense when the mortgage rate is low, when the borrower has strong cash reserves, when there is a long time horizon, when income is stable, and when the person can tolerate market volatility without panicking. In that situation, the mortgage is not necessarily a burden. It may be a low-cost source of leverage. You are using a fixed predictable liability while keeping your capital invested in assets that can grow over time. This path is especially attractive when the mortgage rate is 2%, 3%, or 4%. If you locked in one of those rates, you own something valuable, you own cheap long-term debt in a world where cheap long-term debt may not be easy to replace. The mistake many people make is that they think all debt is bad. All debt is not the same. Bad debt buys things that do not produce value and charges high interest. Good debt can finance a productive asset at a low fixed rate while inflation erodes the real burden. Over time, a low-rate mortgage on a home you can afford is not the same as credit card debt. It should not be treated the same way. That does not mean you should never pay it down. It means you should understand what you are giving up when you do. The second path is paying off the mortgage. This path is optimized for stability and control. It tends to make the most sense when the mortgage rate is higher, when retirement is near, when cash flow feels tight, when the mortgage payment creates stress, or when the household needs a more durable plan. Paying off the mortgage reduces the number of things that can go wrong. It removes a fixed obligation. It makes retirement spending easier to manage. It can reduce the amount you must withdraw from investments. It can give you more psychological freedom. And psychological freedom matters because people do not live inside spreadsheets. They live inside real lives. They make decisions under stress. They panic in downturns. They worry about bills. They make better decisions when their system is not fragile. If paying off the mortgage keeps you from selling investments in a bad market, it may be worth much more than the interest rate alone suggests. That is why I never want to dismiss peace of mind. Peace of mind is not easy to quantify, but it is real. A person who sleeps well and sticks with a plan may do better than a person who has a mathematically optimal plan that they cannot emotionally tolerate. That is one of the core principles of investing. The best plan is not the one that looks best in a model. The best plan is the one you can actually execute through bad conditions. Still, there is a third way. You do not have to choose one extreme. If you are in the gray zone, a hybrid strategy can make a lot of sense. You can continue investing while also making extra principal payments. You can max out retirement accounts and still send an additional amount to the mortgage. You can keep emergency reserves and still reduce debt. You can design the system so that both sides improve. This is often the most realistic answer, because most real people do not only care about maximizing a terminal wealth number, they care about flexibility, they care about safety, they care about progress, they care about control. A hybrid strategy gives you some of each. It reduces the mortgage faster, it keeps money compounding, it lowers regret. If markets boom, you participated. If markets fall, you reduced your debt. That is a good design for uncertainty. Now let us make this more concrete. Imagine a $400,000 mortgage. 30-year fixed, 6.5% interest rate. That is not an obviously cheap mortgage. That is a meaningful liability. Now imagine two different people with that same mortgage. One is 35 years old. The other is 45 years old. The mortgage is the same. The decision is not the same. For the 35-year-old, the strongest asset is time. At 35, this person may have 25 or 30 years before retirement. They may be entering peak earning years. They have decades for investment dollars to compound. They also have decades for markets to recover from recessions and drawdowns. So even with a 6.5% mortgage, I would be careful about going all in on early payoff if that means neglecting investing for several years. Why? Because the early investing years are extremely valuable. A dollar invested at age 35 and left to compound for 30 years at a 7% return can become more than $7. A dollar invested at age 45 has far less time to work. That gap is enormous. If the 35-year-old puts every extra dollar into the mortgage and stops investing, they may reduce interest, but they may also sacrifice the best compounding years of their life. That is not always wise for that person. I would lean toward investing while also making some extra payments. If cash flow allows it, maybe 80% of extra dollars go toward investing and 20% toward the mortgage, or maybe 70% and 30%. The exact number is personal, the principle is not. Protect the compounding engine while reducing the liability gradually. Now take the 45-year-old, same mortgage, same rate, different system. At 45, retirement is closer. There may be 15 to 20 years left before leaving work. The portfolio should be larger, the recovery window is shorter. A large mortgage payment in retirement could create much more stress. So the decision shifts. This person may still invest. They should not abandon compounding, but now paying down the mortgage deserves more weight. Maybe the split becomes 60% investing and 40% mortgage. maybe 50% and 50%, maybe even more toward the mortgage if retirement is approaching quickly and the payment would create strain. At 45, ignoring a high-rate mortgage can create fragility later. It can force higher withdrawals, it can increase sequence risk, it can make the plan dependent on markets behaving well exactly when you need them to behave well. That is not a position I like. I prefer systems that do not require perfect timing. Now let us look at the math of the $400,000 mortgage more deeply. At 6.5% on a 30-year fixed loan, the monthly principal and interest payment is roughly $2,500 over 30 years. The total payments approach $910,000. More than $500,000 of that is interest. That is the nature of long-term amortization. The early years are dominated by interest. The balance comes down slowly at first. That is why early extra payments can be powerful. If you add $500 per month for the first 10 years only, the loan can be paid off roughly 6 or 7 years earlier. The total interest may drop by more than $100,000. That is real money. That is a real guaranteed benefit. But now compare the opportunity cost. If that same $500 per month is invested from age 35 to 45 and earns 7%, it may grow to around $86,000 by age 45. If you then stop contributing and simply let that money compound for another 20 years, by age 65 it could become roughly $330,000. That is also real money. But it is not guaranteed. That is the difference. Mortgage payoff gives you guaranteed savings and reduced liability. Investing gives you uncertain but potentially much larger wealth. Both are true. That is why this decision cannot be reduced to a slogan. People who say always invest are ignoring risk. People who say always pay off debt are ignoring opportunity cost. Good decisions require balance. They require understanding which risk matters most for your life. I would summarize the broad framework this way. If your mortgage rate is below about 4%, it usually makes sense to lean toward keeping the mortgage and investing the extra money, assuming you have adequate liquidity and can tolerate market risk. If your mortgage rate is above about 6%, paying it down becomes much more attractive, especially if you are in your 40s, 50s, or approaching retirement. If you are between 4% and 6%, you are in the gray zone. That is where your personal situation matters most. Your age, your income stability, your savings rate, your tax situation, your portfolio size, your retirement timeline, your emotional tolerance, your desire for control. Those factors may matter more than the interest rate itself. And there is one question I would put above all the others. Does this debt make my plan more fragile? If the answer is yes, then paying it down deserves serious consideration, even if the investment math looks slightly better. If the answer is no, if the mortgage is manageable, low cost, and not threatening your overall plan, then investing may be the better long-term path. That question forces you to think like a risk manager, not just a return chaser. And that is important because many people fail financially, not because they fail to maximize returns. They fail because their system breaks at the wrong time. They have too much fixed costs, too little liquidity, too much debt, too much dependence on markets, too much confidence in smooth conditions. Then a recession comes, a job loss comes, a health problem comes, or a market crash comes. And the system cannot absorb it. A mortgage can be fine in good conditions and dangerous in bad conditions. So do not just ask whether you can afford the payment today, ask whether your plan can survive the payment under stress. That is how I would think about it. There is also the question of liquidity. When you pay down a mortgage, you increase home equity. That sounds good. But home equity is not the same as cash. If you put $50,000 into the mortgage, that money is not easily available later unless you refinance, sell, or borrow against the home. If credit markets tighten or your income falls, that equity may be hard to access when you need it most. That is why I would never aggressively pay down a mortgage before having strong emergency reserves. Liquidity is oxygen. You only notice how important it is when you do not have it. A paid-down mortgage with no cash can still be a fragile position. A person can be house rich and cash poor. That is not control. That is a different kind of trap. So before making extra mortgage payments, I would ask whether the emergency fund is adequate, whether retirement contributions are on track, whether high-interest debt is gone, and whether there is enough flexibility in the system. Do not optimize one part of the machine while ignoring the rest. The whole system matters. There is also the tax question. Mortgage interest may be deductible for some people, but the benefit is not as universal as it once was. Many households take the standard deduction and receive little or no actual tax benefit from mortgage interest. So do not assume the deduction changes everything. Run the numbers. If you receive a real tax benefit, the effective mortgage rate may be lower. If you do not, the stated mortgage rate is much closer to the real cost. Again, the details matter. The same nominal mortgage can have different consequences for different people. That is why principles are more useful than slogans. The principle is this: compare the guaranteed after-tax return of paying down the mortgage with the realistic after-tax risk-adjusted return of investing. Then adjust for time horizon, liquidity, retirement risk, and behavior. That is the machine. When you understand the machine, the decision becomes less emotional. But it will never be purely mathematical. And it should not be. Money is not only numbers. Money is options. Money is safety. Money is freedom from forced decisions. Money is the ability to sleep. For some people, having no mortgage is one of the most valuable forms of psychological wealth. They feel different when the house is paid off. They take fewer bad risks. They retire more confidently. They are not constantly worried about market drops. That has value for other people. Keeping a low-rate mortgage and building a large portfolio creates more freedom. They like liquidity. They like optionality. They understand volatility. They can stay disciplined. That also has value. The wrong answer is not paying off the mortgage. The wrong answer is not investing. The wrong answer is choosing without understanding the trade-off. If someone pays off a 3% mortgage early while ignoring retirement investing for 20 years, they may feel safe but lose enormous compounding. If someone invests aggressively while carrying a 7% mortgage into retirement with no cash cushion, they may look optimized on paper but fragile in real life. Neither is good. The better path is to match the decision to the season of life early in life. Protect compounding. In midlife, balance growth with debt reduction. Near retirement, reduce fragility. Throughout the entire process, keep liquidity. That is a simple sequence. It does not answer every case perfectly, but it keeps you from making the most damaging mistakes. If I had a very low fixed mortgage, strong income, and many years ahead, I would probably not rush to kill that debt. I would invest, build liquidity, and let inflation slowly reduce the real burden of the loan. If I had a high-rate mortgage, weak liquidity, and retirement approaching, I would treat the mortgage as a risk that needs to be reduced. If I were in the middle, I would not try to be clever. I would split the extra money, some toward investments, some toward principal, enough cash on the side to avoid forced selling. That is a practical, durable system, and durable systems beat fragile systems over time. The mortgage versus investing debate will never disappear because it touches both sides of human nature. One side wants growth. The other side wants safety. One side wants maximum upside. The other side wants control. One side trusts history. The other side fears uncertainty. A good plan respects both. So do not let anyone shame you into thinking peace of mind is irrational. And do not let fear trick you into ignoring the power of compounding. You need both perspectives. You need the cold math, and you need the honest assessment of your own behavior. You need to know what the spreadsheet says, and you need to know whether you will still follow the plan when conditions get ugly. Because the best financial decision is not the one that wins only in a perfect scenario. The best financial decision is the one that keeps you moving through many different scenarios. High inflation, low inflation, strong markets, weak markets, job security, job loss, young accumulation, retirement withdrawals, good decisions, hold up across environments. That is what I mean by building a resilient financial system. In the end, paying off your mortgage early or investing instead is not about proving one camp right and the other camp wrong. It is about designing your life so that your assets, liabilities, cash flow, and psychology work together. If keeping the mortgage gives you more growth and flexibility without making your life fragile, that can be the right move. If paying it down gives you control, lowers your fixed expenses, and protects your retirement plan, that can be the right move too. The key is to know what you are buying with each decision. When you invest, you are buying upside liquidity, and compounding when you pay down the mortgage, you are buying certainty, lower fixed expenses, and control. Neither is free. Each has a cost, each has a benefit. The intelligent investor does not ask which one is always better. The intelligent investor asks, which trade-off is right for my system right now? That is the real answer. And if you can think that way, you will make fewer emotional decisions, fewer fragile decisions, and fewer decisions you regret later. Because money is not just about getting the highest return. It is about building a life that can withstand pressure. And when your financial life can withstand pressure, you can make better choices. You can stay calm when others panic. You can keep investing when others are forced to sell. You can retire with less fear. You can make decisions from principle rather than reaction. That is the point of the whole exercise, not just to pay off a house, not just to grow a portfolio, but to build a system that gives you control over your life.